answering your tough financial questions for the past 26 years. It's Allworth's Money Matters with co-hosts Scott Hansen and Pat McLean. Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McLean would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McLean. Thanks for joining us.
That's right. Glad you're with us today as we talk about financial matters. Both myself and my co-host here. We are both financial advisors, certified financial planner, chartered financial consultant. We help people plan their financial future, and glad you are here with us as we're talking about financial matters.
And I'm glad you're here, Mr. Hansen. It's been a while since I have seen you, and will you share with me and the rest of the listeners what has gone on in your and your family's life as of
So
recent?
if you noticed that last weekend we had a best of program where we ran some calls. So my family and myself all contacted COVID. We got COVID. I had just got over COVID.
And did you know where you got it?
No. So it was a couple of weeks ago. We flew out to visit my oldest daughter in Denver. We were there for the weekend, came back the next day. My wife had a bit of a sinus issue, had that for a couple of days, and she felt really fatigued. She was just really, it's like, I don't get it. I'm just super tired. I went for a walk and I'm having trouble going for a walk. And I'd felt fine. And then we were supposed to do this short trip we were going to do. And so I said, well, you can't show up for the trip with any sort of sniffles in this day and age.
Yes.
I said, why don't you just go get tested just to be double safe? And it should happen to be visiting her sister that evening, which was close to a rapid place. And so she got tested and called me. She says, you won't believe it, I've tested positive. And I thought, well, isn't that interesting? So the next day I went and got myself tested, and it came back negative.
And your girls?
Yeah. Jessica out in Denver tested positive. Yep. And so my first test came back negative, and then that evening I started having cold-like symptoms, and I talked to my primary care physician, and she says, go get tested at not one of these rapid places, but a little more in-depth one. So but the next day I felt fairly sick, actually, and I went and got tested and came back positive.
And so how long did the...
So I was sick. It's interesting because...
Was it like a bad flu?
Yeah, you know,
or at least for you. How old are you, Scott?
54.
And by the way, so Scott is, by any standard, in good shape. Runner, cyclist, pretty much watches his diet.
Yeah, I mean,
you take care of yourself.
Yeah, I don't know how much better shape I could be for a 54-year-old.
Yeah,
but so I had, but it was interesting. I got lots of friends were texting me, "How you doing?" But I mean, they're kind of everyone's kind of curious, like what most people don't have anyone close in their life that has had it, and so at least for my symptoms, I felt it was a kind of a combination of cold and flu. I thought I was going to have a bad cough, because sometimes I get bronchitis if I get a bad cold. And so I had the doctor give me an inhaler and some coating cough syrup. I was worried that I wouldn't be able to sleep. But the day after, my cough almost went away. It was a different feeling kind of cough than I would normally have.
Were you tired, run down?
Super tired.
Were you really?
Super fatigued.
And so how long did you...
Fatigued and achy. I'd wake up in the morning just achy, and I had really low fever, like barely at all. Just a really minor fever, but it would come and go because, you can kind of.
So for how many days did this go on?
This was 7 days.
And how about
7 days?
Your wife and daughter? Same?
Well, I say 7 days, but like I'm an active runner and cyclist, I never go a week without doing. And I didn't. It was 9 days later before I went for a little run, and I still don't have my. I was released by the county on Sunday.
Is that a big ceremony or the county release, or is it just a letter?
It's really bizarre.
Do they call you?
Yeah, I got calls.
Do they do? What are they making sure you're staying at home, or what's the?
No, it wasn't heavy-handed like that at all.
Okay.
They just wanted to see if I knew where I got it, if I'd been around any large groups, which I hadn't. And the interesting thing, if I look over the last couple months, there were times when I've been with my wife and with dinner with other people, or with not any parties, but at least some groups of a handful of people. But I had none of that leading up into this. I mean, I could have got it on the airplane, I suppose, but I don't.
Was the airplane full?
Yeah, reasonably full.
Got it.
But anyway.
Who knows where you got it? Anyway, well, it's good to see you. Glad you got that out of the way.
In some aspects, I am as well, right? Because,
well, we don't know whether you can get it again or not.
the odds are no.
Yeah.
Statistically, the chance of getting a second time of any sort of virus. I'm no medical doctor, and I'm not pretending to be one. But what I've read.
And you had lots of time to sit around the house and read. How'd that go?
I didn't. I was so fatigued, I didn't even feel like reading.
Really? You did nothing for 7 days in a row.
I did. Oh, I worked some. I was on some work calls. I was on some calls with you during that time. So I worked, and then I watched more TV than I had in the last year. Yeah. Anyway, here I am. So if you'd like to be a part of the program, we'll talk about financial matters. To join our program, 833-99-WORTH is the number. 833-999-6784. And let's start off here in Denver with Ryan. Ryan, you're with Allworth's Money Matters.
I was listening to your show for the first time about 2 weeks ago and decided to call in. And I'll say this is a treat to the Denver area. And I absolutely love having a show now that talks money and investments and finance. So
well, thank you, Ryan.
I appreciate you taking my call.
Oh, good.
My call really was, I'd say, generated with my concern just on the effects of COVID and what it's doing to, obviously, the market. And I'm curious, my first question would be, what asset class you guys kind of favor within this treasury environment? And then my second question would kind of be, what are your feelings on REITs or real estate investment trusts that have exposure to a lot of commercial real estate, such as malls and things like that?
So when you talk about the REITs, real estate investment trust, do you own any now?
I do. I have quite a bit, and they're performing quite well. But when I think I have a lot of exposure through Brookfield Property as a group that I hold some REIT through. And I guess my worry is, like, when I go out into the world and it seems like everything is so less busy, or are these big structures going to survive? Or as somebody who's keeping an eye on their retirement, is this something that I should start considering moving money out of?
Yeah.
But interest rates are super low, right? So that's what fuels that's where I'm calling the experts.
Thank you. So what you hit on, and for the rest of the listeners, there's two types of REITs. They're non-traded real estate investment trusts that are sold by brokers and high commission salespeople,
which are not worth your time,
which you do not want. Or you have what Ryan owns, which are publicly traded, which you can buy on an open market. So you own the right class of REITs. The question is, do you own the right kind of REITs? And you're correct. One of the things that actually has propped up the REITs is the low interest rate environment.
And lack of alternatives.
So
I was in a meeting just this week with a friend of mine who runs I'm trying to describe this. It's a company that provides all the services that someone would need in the midst of a commercial real estate transaction. So just like when you buy a home, there's certain inspections you need and the title report and all that. The same sort of stuff happens in the commercial space. And so his company specializes in helping banks, community banks, investors do all the reports and whatnot. And the reason I'm telling you this is because they're talking about, they said right now the transactions in commercial real estate are off about 2/3 from this period versus last year. So 60 some odd % decline in commercial real estate transactions. In other words, there's hardly any commercial real estate transactions going on right now.
Yep.
But they're predicting declines in the somewhere between 25 and 40%. This is what internally they think that you're going to see a decline in value of these real estate prices when they do begin to transact. So right now there's not much of a market for them, right? It's very different than the home buying market. Residential market's on fire. Commercial, it's like only a third of the transactions are happening. Who knows what these values are?
And remember, there's some of the legislation that's taking place on a national basis that's actually causing a decrease in the value of these properties, as well as they're not financed the same way as a residential property.
Now, they have much more equity in them, which on a good note, I mean, the commercial real estate maybe have 50% leverage on it, so it's not the same as someone putting 2% down and buying a home.
So back to your question, and you use this low treasury rate environment, which actually I think is appropriate. How much of your portfolio do you have? How old are you, number one?
I am going to be 39. Been investing since a young age. I've had good mentors around me. As far as my portfolio exposure, I'd say it's probably, I think, 50% right now in REITs.
Wow.
How long has it been 50%?
Probably the last 2 years.
And did you do that? Did you have it in fixed income before? Or did you have it in equities? What did you have it prior to the 2 years? How much was in REIT? Where'd you move it from?
Yeah, a lot of different places. Some oil and gas. Quite honestly, some came from a real estate transaction that I completed that I kind of rolled it into that.
Got it. Yeah, you want to keep some exposure.
Yeah, exactly. So I guess I have a lot of time before my retirement, but I saw what happened in 2008 when the market made the correction on the residential side, and I fear so much on the commercial side. I mean, and I don't know if I need to, right? So I did some really drilling into, I don't know if you guys heard that JCPenney's got bought out.
Yeah, I think by the mall owners, didn't they?
Yeah, the mall owners bought them, which I own both of them, Brookfield and Simon. But the details of the deal, they got, and it was only within malls they owned the JCPenney on.
That's right.
They didn't buy the distribution, but I believe they got the land value at a 50% 50% discount. They got the buildings and operations free. They paid $600,000 per JCPenney.
Yep.
So for me, I'm like, that is an extremely crazy good deal. Like, do I need to worry? If these are the type of deals that are going through with the REITs because the commercial market
depends what
so
side of the
weak right
equation you're on.
Someone was selling that,
right?
Yeah. I mean,
I wouldn't be excited about being a mall owner right now.
Well, it'll be interesting to see what they do with these malls if they turn them into giant Amazon warehouses in the middle. I have a friend that was actually buying an old Macy's store and trying to turn half of it into a mini storage.
Yep. And I think you're going to see that, and that's why I'm okay with it. But I've listened to you guys.
50%. I mean, 50% in publicly traded REITs is a huge percentage.
That is
for liquid investment.
You're overweighted in REITs.
Yep. Okay.
I mean,
you would say scale back
half.
that position.
Well, we have as our firm we have a pretty small exposure to REITs right now. Almost a couple percent or something, very small.
Okay.
Yeah, I mean, you need to cut that position by half.
At least.
Okay.
I mean, I wouldn't feel comfortable with that.
No, I wouldn't feel comfortable with over 25% of my portfolio.
But I have no idea. Look, I have no idea where prices are going to go over the next couple of years. Nobody does. Anyone who says they do, they're crazy, right? I mean, come on, nobody knows.
Yep.
What we do know is we can look at risks and probabilities of return, right? So, like when asset prices go higher and higher and higher, at some point in time, you're like, well, how far can they go, right? Like without any change in fundamental earnings, or the other way around. So there might be times when look, from a statistical standpoint, it makes sense to overweight in one particular area than another area. But as far as the real estate market, and maybe the commercial real estate market will, I mean, I can't imagine how it's going to blow past this without any decrease in value because people aren't paying their rents.
Yeah. Well, and just so you guys know, the reason I'm 50%, and I've known this, but the REITs I'm in, one of them is paying me a 12% dividend, I think, on the month. So I've just been collecting that the whole way, and now I'm like, I think I may need to switch my portfolio. I'm so happy I talked to you guys.
Well, that should scare you. That 12% dividends should scare you a little bit.
Why in the world? Yeah, because a quality commercial, the cap rates are much less than that.
Yeah, they're sixes.
Yep.
Right?
Trust me, you guys are hearing what I was looking at. So
yeah, the higher the dividend, the
pointing
scarier it can get.
And are these these are publicly traded REITs that have always been publicly traded, or were these at one point in time non-publicly traded that have then went public?
The ones I have majority of my money on have been long-term publicly traded. One is 95 years, I think, old company, and the other one been around for a while.
You should most certainly trim those positions. And anytime things paying a 12% dividend, that's an indication of the risk in the underlying asset.
Okay.
Yeah.
All
no
right.
one should be having to pay that much.
So I appreciate the call, Ryan.
Good luck to you, Ryan. Now there was just this last week or two, there was a non-publicly traded REIT that went public. Did you read this? It was one of the AR Realty, Nicholas Schorsch's deal. Schorsch. And it's down 80% in value from where it originally launched several years ago.
When it was non-traded.
But right when it went, right before it was non-traded earlier this year, it was $21 a share or something like that from the original 25. So it was down a little, and then it started trading publicly, and it just cratered.
And that,
if you own some non-publicly traded REITs, don't believe whatever value it states on your statement.
Whatever that statement says. If they're not publicly traded, which means they're not traded in a secondary market, there's no liquidity involved in it. Whatever that statement says, the value is, don't pay any attention to it.
Yeah, don't buy any non-publicly traded REITs. I just don't understand. If you're gonna want to own a passive real estate, buy something publicly traded. You can buy it today, sell it tomorrow.
They're not bought; they're sold.
They're sold. Yeah.
Non-traded REITs are sold.
And let's talk now with Christina. Christina, you're with Allworth's Money Matters.
Hi, thank you for taking my question.
Yes.
So I'm a federal government employee. I have a TSP account. And in March of this year, I lost about $45,000 within 2 weeks due to the COVID pandemic. And so just when the market started coming back up, President Trump was diagnosed with COVID, and then everything seemed to come crashing back down again. So I'm wondering, how is the president's diagnosis?
Crashing back down. The markets are dramatic. The markets are up 50% or so from their low.
Right. That is right. Yes. And I started going back into the market again very cautiously.
Oh.
And then this last week, Friday, when they said that President Trump had COVID, it seemed that all the market went down. And then again, I think it was yesterday or whenever he just said that he wasn't going to do the stimulus package for COVID. So that affected the stock market.
Uh-huh.
So now I'm kind of wondering, how should I invest my investment?
Did you buy? Were you happy when it went down?
Well, no. I lost $45,000.
Did you sell out your positions though at the bottom of the market?
I changed all of my investments to be into government bonds. About 95% of it. I changed everything over immediately.
And sounds like before you were almost 100% stocks. Otherwise, you wouldn't have had that high of a percentage drop.
I had a good amount of money in the stocks, yes.
How old are you, Christina?
I would say I'd have about like 40%.
How old are you?
I'm going to be 62.
And are you retired or working?
No, I'm going to retire in 5 years, so I'm still working.
So what have you learned from this, and what do you plan on doing?
Yeah, what do you think you should do?
Well, I was kind of kicking myself that I left my stocks in the G fund for the last almost 6 months, because I could have made more money. I most likely would have made the money that I lost back.
Yes, that's
but
correct.
I was being too cautious.
That's right.
So I would say maybe within the last 4 weeks I changed it over, and I just started to see the returns coming back to me, and then the COVID hit the president.
Yeah. So let's think about this.
I think it came back.
Yeah. Well, it depends on what day we're looking at. But let's think about this.
And how much your portfolio is in stocks now?
Well, I panicked and I switched all of my stocks back into just general bonds, government bonds.
And then
about
how much
90%.
did you move back to stocks in the last month or so?
Prior to that, it was at least, I think it was about 30%.
Okay. Has there been a life change in the last year or year and a half that has worried you? Is there something else going on other than your investments? Like a change in job status, relationship status, something like that?
No.
Okay.
No. I'm just really trying to be cautious because I want to retire within the next 5 years.
And so you're, presumably, you're a federal employee.
Yeah, she said.
Oh, I'm sorry. I missed that, or I forgot it. So you're a federal employee. You're going to have to put together a strategy of what your allocation is, and then you got to stick with it regardless of what the headline says, regardless of whether Donald Trump gets COVID or not, regardless of who the next president, regardless if there seems to be a war in the Middle East, regardless of someone breaks into the Watergate building and they find bugs, regardless if Ted Kennedy gets shot, regardless, right? Regardless. And the reason being is what you just saw there is you were trying to build a portfolio based on headlines. And there is a complete disconnect oftentimes between the economic environment in which we live and the markets. And so what you were doing is reacting emotionally in a manner that you were predicting things in your head that either came through or didn't come through, but the reality is it's the timing of those things. So you need to sit down with an advisor and build a portfolio that says, look, Christina, this is what your portfolio should look like in 5 years. This is how much risk you're going to take. There's going to be 50% in stock and 50% in bonds. And oh, by the way, in 5 years, when you retire, this is what your monthly pension will be. Oh, and this is how much money you can take out of your thrift savings plan. And, oh, by the way, even if we go through a down market, you have 10 years of bond in the thrift savings plan in order to support you, in order to get through the backside of the market. Because we coming to us and saying, when do I get back in? This is right because we took the hit and we didn't get the gain on the backside, right?
Right.
So it's how you're reacting to the markets emotionally, because the markets are going to do what they're going to do. And I promise you, you are a young lady. You have lots of life in front of you. Over the next 25, 30 years in retirement, you're going to see this 2-3 more times. So either decide that you're completely out of the market, and that's the way you're going to live, which is fine, by the way.
If you can afford it.
If you can afford it, which is fine. And by the way, it wouldn't even be the bond fund that I'd put it in. I'd put it in cash accounts, which yield almost nothing, which is fine as long as you recognize that that's your plan. But whatever your plan is, you got to stick to the plan.
Right.
Right.
That's true. I just think, I had a plan, and then when I lost so much money within that 2-week time frame, that really scared me. I got worried.
That's right. That is right. So sometimes.
But you probably had more in stocks than you
realize. So
yeah.
Sometimes it's okay to go to a professional and actually have them explain it to you and build the plan for you, right? And you're going to pay for that, but it's gonna
be less than this.
It's gonna cost a lot less than these types of decision making that you're going through. And they can stress test a portfolio. And stress testing a portfolio says, if the market falls by 30%, this is what your portfolio most likely will do. If the market goes up by 30%, this is what the portfolio.
So you can get a
most likely
feel
do.
ahead of time of what your portfolio, how it might react to different things that could happen.
And it's okay to bring in outside. Look, I have a pretty good understanding of tax, and my wife is an accountant by education. We have a professional tax preparer a CPA do our tax return. Why? I want their view of the world.
Right.
I pay for that. Okay. I want their view of the world. It's important to me.
Okay.
So The sooner you sit down with someone and figure out what the portfolio should look like, the better it is. And then just pretend it's, Scott Hansen I've known Scott for over 30 years. And he used to say to me, Pat, this is back in the days, he goes, if you plant strawberries and you pulled them out of the ground once a week to see how the roots were doing, they wouldn't grow very well, would they? You remember these analogies?
Yes.
And so the idea being that it's going to do what it's going to do.
And you have no idea. Nobody has any idea in the short term.
So all you're trying to do is mitigate risk and determine how much risk you're willing to take. And by the way, you might not have to take any risk at all if you've got enough to retire comfortably and you have no debt and your pension actually provides a nice lifestyle. Why take risk?
Right. But the government pension is 1%. So I'm not really counting on that.
Oh. And then we really need to make sure you get the right plan in place
right.
this. That's probably
even more
important
so
than ever. So I hope this was helpful, Christina. Glad you called. All right, we're taking a quick break. Stick around for more Allworth's Money Matters.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Hey, I want to let you know we've got our 7 personal decision point virtual workshop. So it's a virtual workshop. If you're nearing retirement, you'll want to check it out. We're starting to broadcast October 20th and the 22nd. Full details at allworthfinancial.com. Welcome back to Allworth's Money Matters. Scott Hansen here.
Pat McClain.
I'm glad you are being part of our program as we're talking about financial matters. And if you got a question regarding really anything financial, retirement, investments, estate planning, taxes, love to take.
And I hope you're all well. I got to share a little something.
What does that mean?
I hope everyone's well that's listening to the show.
Okay.
But I am going to share a little something that. So my daughter, who graduated with a master's in education last year, teaches at a school in a low-income area of town.
Yes.
And so...
remotely, I'm assuming.
Remotely.
When are they going back in?
She doesn't know, but she does get asked. She teaches the 5th grade. She gets asked every day. Every day. Do you think we'll be back in school by Halloween? Do you think we'll be back in school by Thanksgiving? So... I'm working at home remotely, and she texts me, and she's like, Dad, you got to see this Zoom. And so I look at the Zoom, and so she's living with us for now. But so she goes,
As so many other young people.
Yeah,
All
she's
right.
like, and by the way, I have 4 children, and Colleen, I like her living there. She's actually a good cook. She cleans up after herself. I was out.
Brings you your slippers in the evening.
I was out of town. I asked her to do things. It gets done anyway. But she says she texts me. She said, "Hey, if you get a couple minutes, come into my office and watch these kids do PE." Remotely. And so I go in there, and there's a PE teacher on the Zoom, if you can imagine this, and he has these kids fill up backpacks with books or whatever, and he's got them doing curls in front of the Zoom. And he's counting
with
backpacks, and then they're lifting the backpacks over their head and they're counting. Oh, and then he's showing them how to do.
What percentage of these kids have no access to the remote learning?
Oh, they all have access to the remote learning, whether they show up or not. Is
okay. Well, that's a better way. Yeah,
that's a completely
what
different.
What percentage are?
So she says a good 75% show up.
25%. But
it's not always the same people.
Okay.
And so it's not even the whole day. So sometimes they just drop out in the middle of the day. And what she does is she has the parents. She has the kids' text numbers and the parents' text numbers, and she'll text because the kids will actually go into their room and tell mom they're in school.
No way. It's hard to believe.
And the mom,
also, I could say it's a good thing in junior high that this didn't exist, because I would have never been on a Zoom call.
I did tell my daughter. I said, can you blame them? But she said so. Sometimes that she'll text the parents, say like, your kid never came back from lunch. And the parent will go in there, and the kid's playing Fortnite.
Oh, gosh.
Anyway, but I watched the Zoom video of the 5th graders doing a PE class for about 10 minutes, and I got to tell you, it was quite humorous. I felt bad for the kids because They really probably should be running around on a playground somewhere, but they were putting their all into lifting the.
Well, one day things will go back to somewhat
let's
normal
hope.
again.
Let's hope.
833-99 Worth is our number. Let's talk to Danita. Danita, you're with Allworth's Money Matters.
Hi, Scott. Hi, Pat. Thank you for taking my question.
Yeah,
Sure.
Thank you.
So I am 30. I bought a townhome last year. I live in Charlotte, North Carolina.
Congrats.
Thank you. So 30-year fixed rate, 4%. I didn't put much down because I didn't have to. I had a plan of saving up money every couple of years, pulling it out, and recasting my mortgage. Wanted your
Why would you do that?
To lower my monthly payments. Eventually, I plan on staying in this townhome for probably 5 years and then renting it out.
Okay.
So lowering the monthly payments would give me a better profit renting. Or would you say I should take a riskier investment and kind of put that money elsewhere?
Well,
What's your plan? I was confused in your plan. I thought it made it sound like you're going to do the opposite. So you're saving up money for what?
she's going to put lump sums in every couple
Lump
years and then
sum.
recast the mortgage to lower the monthly mortgage payment so that when she does convert to a rental, her monthly payments will be lower.
My understanding, some mortgages will allow for recast, reamortization, and some will not.
Yep.
Does yours allow for that?
It does allow.
So what you want to do is take the next 5 years, see how far you can get your mortgage balance down, and then go buy a different place and rent this thing out. Is that right? Is that right?
Is that what you're saying?
Yes. So I was planning to rent this place out and I'll find a different home for myself.
Okay, and what will you use for a down payment on a new home in 5 years?
Good question.
Okay. So I would not pay down the mortgage. I would actually just put it in a high yield savings account. If that was
nothing's really high yield relative.
relative, it says high yield. It's not really high yield. It just says high yield.
Because relative to 0.4 is pretty dang high.
Yeah. So I would not pay down the mortgage. I would save the money in a side pocket or a supposedly high yield savings account so that you actually have money for a down payment on a house if that was in fact the goal in 5 years is to convert
what is your
money.
ultimate goal? Forget about the financial strategy here. You've bought this townhouse at age 29, which is good for you, right? And is it that you would like a nicer place at some time in your future and your career's going well and that's that the plan is going to be? Or is that, what's the motivation behind this?
It's actually a pretty nice place. Just logistically, I would prefer a different setup maybe in about 5 years or so. Something with a backyard.
Got it.
Things like that.
So I would think of it instead of, and at 29, I wouldn't be in a rush to try to pay this thing down either. I like Pat's idea of if you think you might want to live somewhere else and you could afford to save some money up for that next house to help with the down payment.
And don't worry about this payment.
And at that time, you may choose to just sell this and enroll the equity into your new house, or you may choose to sell it and buy a different rental. Because assuming you're going to get gain in this over the next 5 years, you have an opportunity to sell your primary residence and avoid up to $250,000 worth of gain. If you convert it to a rental, then you'll lose that opportunity.
Yeah. So let's worry about 5 years from now. But if you're able to save money on a monthly basis, don't put it against the mortgage. Just save it in the side pocket.
Yeah, totally agree.
And
with
I
that.
assume you have a good paying job.
I do. This is my only debt, really.
Good for you.
So I'm kind of anxious to get it out of my hair.
Well, you're 30 years old.
I know, but
For gosh sakes, just slow down a little bit.
Okay, so I'm not a big fan of debt, right? And we like to talk about having your house paid off by the time you hit retirement age. But the home mortgage is, as far as debt goes, it's a pretty good one because
It's subsidized by the government.
and you'd assume over the long term your home is going to appreciate at a much more rapid pace than what you're paying on your interest on your loan, and that interest is going to be fixed even if we have a high rate of inflation. So debt tends to do pretty well during inflationary times. And if you're you're young and healthy and you've got a good career, unless you're thinking if something's going to change in your career, or you're planning on leaving the workforce or something along those lines, I'd be in no rush of getting this thing paid down. I would consider refinancing now.
I would consider. I was going to go there.
Because you might get 3% today instead of 4%.
Yeah.
What's the value of the home?
Okay. About $360.
And what do you owe on it?
Oh, probably close to that. I didn't put much down.
Oh, got it. So
And I just bought it last year.
Just call a couple brokers and see if it makes sense for you to refinance.
Okay.
Alrighty.
One other question I have.
Sure.
Have you guys heard of the term, or I guess use this approach, velocity banking?
I have.
I have no idea what that means.
I've heard of it. Tell me
Or
what your
HELOC.
Tell me what your understanding of it is.
I haven't done all the research, but in most cases, obtaining a HELOC or home equity line of credit, and I guess they basically buy out your mortgage and provide you this line of credit for the value of your home. I think in most cases the rates are variable, so that makes it a little bit more risky.
That's right. And normally, what happens is this. By the way, this velocity.
And you
banking,
don't get if you borrow more than your home's indebtedness, you're not going to be able to take the tax deduction.
That's right.
Either.
So this velocity banking is just it's lipstick on a pig. It is just another way of using your home equity, and so the idea is that you're using your home equity as a kind of a banking deposit where your money comes. You get your paychecks deposited directly in your home equity line of credit, and then you use that kind of as your savings account. And because you're doing that, assuming that you're going to spend less than the money put in, you will slowly be paying your home over time. It's all garbage. It's just it's lipstick on a pig. There's more danger in it. And by the way, it wouldn't apply to you anyway because you don't have any equity in your home to speak of.
Right.
So leave
well,
that.
and a home equity line of credit is the opposite of what you think your goal is.
That's right.
It's taking more debt against your house.
Well, the idea behind this, the velocity banking, Scott, is that you take your home equity line of credit and you take out big chunks of that, and then you pay it down on your first mortgage.
What's the benefit?
Well, I couldn't figure it out. I just could tell
Unless the benefit is that it has a current rate that's lower because it's a variable rate note.
There is that. There could
My
be
biggest
that
problem with debt is the lenders always want to be repaid.
Yeah, but
if at times they didn't care about being repaid, I'd be a tremendous fan. But they always want to be repaid.
Mm-hmm.
Well, we shouldn't say that. The FHA loans may not have to always be repaid. Right. When you say
you go into bankruptcy,
private lenders want to be repaid.
All right.
Government-backed loans don't always have.
It sounds like you're on the right track.
Yeah, don't mess with that velocity.
Make sure you're saving in your employer's retirement plan. If they don't have one, then make sure you're putting money into an IRA. You can put $6,000 a year into that. So, save at least 10% a year towards retirement, regardless. Appreciate the call. I had a friend of mine forward me an email from her son. Would you mind looking at my son's portfolio? And at first I thought, oh, you got to be kidding me, really? And I thought he was like 19-year-old college student. I thought it was going to be like some day trading account, which I think those are the most ridiculous. They're silly because you're in a class for a semester. I remember doing something like this back when I was in college. You're in this semester and you're supposed to pick stocks, and there's a bit of a contest between who does the best during the semester. Like that's it's total luck.
Yeah.
Short period. That's what I was expecting to see. Instead, it's this 19-year-old. He's saving $300 a month. He's got this highly diversified portfolio. 60% are indexes, ETFs with Vanguard. And then he's got like 20% in stocks and all these different individual stocks, highly diversified.
Wow.
Some that I wouldn't own or otherwise. And then he said something about the FIRE, financial independence.
Oh, is that right?
Early. And I thought, here's this 19-year-old.
He doesn't even have a job
yet.
He
must have some job. He's saving $300 a month.
But he wants to retire already, and he's 19.
I don't know if he wants to retire, but
what's a FIRE mean? Financial independence.
He wants to get to. He said something about Mom and Dad. I want to get financial independence, and he laid out his plan, and he wanted some advice. And so I'm friends with her. She's like, "Hey, I don't know what to tell this kid." My bottom line to her was like, "I don't think you need to worry about this one."
Yeah.
Any 19-year-old who's saving $300 a month.
And you just called him back and told him to marry money. It's easier.
I was telling I was talking to my daughter about finding a rich guy. My wife was offended by it. Really? I was joking with her. My wife took offense. Like, well, that's the kind of thing that you think she should be looking for in a man. I'm like, I'm just, obviously, I'm tongue in cheek.
Listen, if everything else is equal, yes.
I mean, they go off the bell curve. You might as well go to that far end stretch on one side.
Listen, so is that what you should be looking for? No, but if everything else is equal.
On a serious note, though, and if at a stage, it's one thing when you're 25 or 30. When you are 60 or 55 and you find yourself being single, either because you were widowed or through a divorce, you need to be really careful.
That's true. Yeah.
Because we've seen it where, look,
I had an old guy without a lot of money tell me once all he was looking for was a nurse with a purse. That's what he said. I'm like, that's what you want out of a relationship. He said, look. I'm like, well, he wasn't a client, by the
way. That's good.
He was a relative.
But you've seen clients.
Oh, you've seen it. Oh, yes. Oh, there's no question. Where you have seen it, second marriage, third marriage, late in life, widow,
people living
widower.
together.
Yes.
And
you got to be careful. But at 19,
no, 19. 833-99-WORTH is to be part of Allworth Financial's Money Matters. And we're talking with Gene. Gene, you're with Scott Hansen and Pat McLean of Allworth Financial.
Hey, Pat, how's it going? I enjoy watching your show.
Well, thank you.
Hey, I got a question. You know, this stock market is kind of crazy. I'm 69, and I've just been flying by the seat of my britches all these years. And it seems like over the years I haven't really made hardly anything in stocks. But the last 2 years have just been unreal. I can't believe it. And anyway, I got out of the stocks last year, made money, got back in. I got out the first of this year, and I made $350,000. And then I sold again, and I started buying back in June, and I can't believe it. It's like I won the lotto. My account is already up $523,000, 23%, and I just feel tempted to take the profits. But the thing that scares me or concerns me is the idea of paying the taxes. And I do worry about Biden becoming the president and what he might do to the stock market.
Gene,
what are your thoughts on that?
So you stated that you really hadn't made much money in the stock market up until the last couple of years.
2 years.
Why?
I don't know. I just wasn't very lucky.
Well, it doesn't have anything to do with luck.
So the Dow's roughly 28,000, give or take, right?
Mm-hmm.
So I started in this industry 30 years ago, in 1990, and the Dow was roughly 2,600 back then.
Wow.
So over 30 years, it's gone up tenfold, not counting dividends. So when you say I haven't made any money in the stock market except for the last couple, I don't understand. I
made money, but it wasn't really anything significant.
Tenfold.
Well, so how long have you been investing for?
Probably the last 10 years.
Okay. And so based upon what the numbers that you just shared with me, the money you're investing is approximately $2.2 million. Is that correct?
No, actually, I was only in for 1.4, and I took $300,000 out last year. But I currently have an account balance of $2,700,000.
Okay. Because you said you made $500,000, and it was up 23% since June, which is where we got to the 2.2.
What percentage of your portfolio is in stocks right now?
I would say probably 80%.
Okay, so I mean, what you're doing, it's like you're getting on the freeway going 100 miles an hour, and then you're stopping, pulling off on the side of the road, and then you wait till it feels safe again. Then you're going 100 miles an hour, and then you're pulling off from the stop and wait till it's safe again, right?
I have, but every time I get too high up, I feel, how should I say? I feel like, wow, I can't keep going.
Well, how many times have you been wrong?
Probably most of the time.
Okay.
I've been lucky, though. It's worked out for me.
No. Imagine how you would have done had you just stayed invested the whole time. Because you missed some of the downturns, but you missed a lot of the uptick too. So
I probably did.
So there's a better way to look at life. which is it.
There's a better way to look at life.
Right? No, life is not black and white. Most of life is
Maybe
actually
it is
gray.
for Gene.
It sounds like it is for Gene.
Okay, so
Gene's colorblind. Gene, would you agree that life is not black and or white?
I agree. I agree.
So your
It's just that
portfolio
this year
doesn't have to be black or white either.
Mm-hmm.
Right? So if you were an institutional pension fund, you would write an investment policy statement and you would manage the money to that investment policy statement. So what's an investment policy statement? Well, it could say that I want my portfolio to be 60% equity or equity-like instruments and 40% bond or bond-type instruments.
Mm-hmm.
And that anytime it gets more than 65% in stock, I'm going to sell stock and buy bonds. Anytime it gets to 55% in bonds, 45% in bonds, I'm going to sell bonds and buy stocks. So you're constantly buying and selling in order to keep yourself in the middle of the road. But you've been, like Scott said, go 100 miles an hour, pull to the side of the road, 100 miles an hour.
And our concern with it, Gene, is that studies have shown that nobody's able to do this consistently over time and have a better rate of return than just having a broad, diversified approach going in. And the problem is if you time something poorly, it can have devastating effects. So we see much downside and little upside to the approach you're taking.
Mm-hmm.
So and you're managing the money yourself?
Yeah.
Okay. Well,
It just blows my mind. It's up 43% this year.
okay.
Physical year, I should say.
Okay, well,
Good. That's good. That's good. But over the long term, you're 69 years of age, right?
Yeah.
You need to write an investment policy statement for your life.
What kind of return are you expecting out of these dollars on average, the next 10 years?
You know, I really have no idea because I might, if I got out, I would prefer to wait until after January and hopefully Trump would still be in and maybe March or April get back out.
Okay, and let's say that all happens over the next 10 years.
Mm-hmm.
What do you expect to earn on these dollars?
In all honesty, it doesn't matter as long as I don't lose ground. Yeah,
And what is ground? What is losing? So is a high watermark always your new basis?
I guess what it is right now, with the money I have, I feel like it's enough to last my wife and I the rest of our lives. I'm 69. I don't know how many years I have. I don't know how many years my wife has. She's 65. But yet at the same point in time, I feel like it's adequate to cover us as long as I'm making
So if you're
money.
my brother and told me that, what I would say is, okay, Gene, it makes no sense to take these huge bets that you're doing right now because you make a poor bet and you're wrong, and it's going to it'll have lasting implications on your standard of living. If you're clearly at a point in life where you don't need any additional assets and you've got enough to maintain your same standard of living, why take that risk?
So you would suggest getting out then altogether?
No, I would not. I would suggest having an approach that's designed to weather whatever happens. Who the heck knows who's going to win the election?
Nobody does.
Nobody does. And even if Trump's reelected, what makes you think the stock market's going to keep going up? Maybe it'll go down. Maybe he'll get COVID a second time and die this time. I mean, who knows what can happen? Maybe a meteor's going to fall on the White House. I mean, no, right? So we have no idea what's going to happen in the future. Nobody knows how, and to try to bet that the stock market, like you believe you got some knowledge of the future that the rest of the market doesn't have. I mean, that's basically what you're saying.
Well, I don't really believe I do. I've been really fortunate. The first years, I would make some big wins and I'd make some big losses.
Okay.
So
all right.
Our approach, it sounds like, you remind me of a friend who was gambling up in Lake Tahoe at the casino, and he was telling me that how he kept getting lucky at blackjack, and he kept making all these dollars, and he was telling me how good he is at the game. Well, I do understand probabilities, and I understand games like blackjack. you play long enough, the casino's going to take your money. Statistically, that's how it works, right? I mean, that's how they stay in business. But just because you win blackjack 20 times in a row doesn't mean you're good at it. It just means you've had a lucky run. And frankly, if you in fact have done better than the market the last decade by going in and out, which I'm highly suspect that you have, but let's assume for a moment that you have made good calls, I would base it 100% on luck and not on skill. 100%. So anyway, wish you well, Gene. I would not take that approach of getting in and out of the market. I think it's very dangerous, particularly at age 69. So,
thank you, Scott. That's I appreciate your comments there. You're a much more patient man than I.
No, I mean, it's just
Scott, you're a much more patient man than I.
Okay.
So anyway, I wanted to talk briefly.
About a minute ago, Pat's attention span just totally switched.
He wasn't going to listen.
No, I know.
He didn't care what we said. He called to tell us how well he did in his portfolio, whether that was based on
what I find interesting?
Not, I don't know.
So here we've got 80 plus financial advisors at Allworth, right? And the good advisors are the ones. They're all good advisors, but the ones that get so bothered by they can't influence someone's behavior, right? And particularly younger advisors. Then after a while, I guess it's kind of like a doctor's trying to tell his patients not to smoke.
Yeah.
Right. After a while, you can either beat yourself up because you have patients who smoke, or you just say, that's just reality.
Yeah.
I have some patients who smoke. That's not smart, but they do it anyway. And I get it's the same sort of thing with.
But if market timing worked, we were lucky enough to talk to the only man in America that actually has been able to make it work for a long period of time. And aren't we fortunate? Otherwise, people use, and he seemed like a nice enough man, but people use an investment policy statement and stick to it through good times and bads to get to their desired outcome. That's how it's done. If you're an institutional pension, if you're an endowment.
Having a sound investment strategy.
And sticking to it good times and bad.
That's the hard thing to do.
That's the hard thing to do, but that's how it works. You sell things that go up. You buy things that go down. That's how it works.
That is how it works. Anyway, we are out of time, unfortunately. But by the way, if you don't listen to this podcast, I believe we have more podcast subscribers than we have on terrestrial radio. And you can get the podcast wherever you listen to your podcasts, or you can go to allworthfinancial.com and sign up there. And actually, on our website, we've got a lot of other great topics of educational material, and we've got a
personal learning platform, which is quite fun.
Which you can, if you're looking for
customized advice, you just go in and it will ask you a couple of questions, and it will give you articles and videos to watch that pertain to your particular situation.
Yeah. Anyway, it's been good being with you. We'll see you next week. This has been Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.